This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got another great guest for you today. He's a mobile home and RV broker. He owns and operates mobile home parks. He's developing an RV park. So we got a jack of all trades. He also does some third-party management from time to time. So really excited to have our guest here. My friend, please help me welcome Enon Winkler. Enon, thanks for coming on, man.
Yeah, thanks, Ferd. I appreciate it. So thanks for the introduction, man. That's great. How's things going with you?
Hey, all is well. It snowed here in beautiful Kansas City. So for our listeners, it's November 15th as we record this. So we're going to talk, I know, later here about market conditions so they get a better feel for this time of our life. But all is well here. Tell us about yourself, man. I know you, but for our guests that may not, give us a little more of your background, how you got in the space.
Yeah, I appreciate it. So I started out on Wall Street, and that was great. It was the most amazing job out of college that anyone could ever have. But, quickly 3 to 4 years into it, I realized there wasn't a lot of growth. So I really struggled with that. The money was great. The atmosphere was kind of like a boiler room, but I really wanted to grow. That was important to me. So I started looking around into real estate and what I wanted to do. And I read a book called Rich Dad, Poor Dad. And that really kind of let me understand that each property out there is owned by someone. I never really thought of it like that. So once I realized that, and they produce cash flow and it's having your money work for your money, I just thought of the world differently. So I wanted to get into real estate, and I started researching, what do I get into? And ultimately I ended up choosing to go into multifamily, which was a great decision. I was a multifamily brokerage for a large brokerage firm out of Orlando, and I crushed it. So from 2004, when I started, to, I would say 2009-ish, before the world fell apart, I did probably right at $1 billion in apartment sales and was one of the top guys in Central Florida, and it was great. In 2009, I kind of retired, to be honest with you. I worked on a company that me and some of my buddies started called Red Carpet Monday. So I focused on growing that. That's an internet company that we call it Bizertainment. It's online and offline social media. And it was similar to MySpace at the time when it started, but we also incorporated events. So it's super cool. We had a great following. It's still a great event till this day. But when I left the brokerage world and was trying to figure out what to do next, because there wasn't anything trading, I grew that from Orlando to Tampa, Atlanta, Dallas. We partnered with Mark Cuban in Dallas, which was pretty cool, and his people. And we actually had, through Red Carpet Monday, we had a Shark Tank viewing in Orlando downtown where Mark Cuban and Damon came. So it's super cool, super exciting business to be a part of. And then I started getting, antsy to get back in real estate. And in 2011, I was out there looking for something to buy because, most brokers at some point in their life want to buy and own properties. And so in 2011, I bought my first mobile home park in Kissimmee, Florida. It was a 93 space, 55 and older mobile home park, and I bought it and I ran it, and I had to go figure it out. So that's what started it all with the mobile home park space. It was really foreign to me though that time. All I thought was apartments. And through that process, I ended up buying 4 more parks in Georgia through a 15 property portfolio, in which different guys that I work with a lot, we all bought different tranches, and I took the Georgia stuff, and that was 485 lots, something like that. And out of the 485, I'll give an example. The largest park was 219 lots. There were approximately 180 homes, and 160 of them were vacant, dilapidated.
Oh, wow.
So
you became a remodeler.
That kind of went through the other parks. Well, we bought it at a price that we were pretty certain we weren't going to go wrong, but we had a lot of work to do. So, I would say from 2013 to 2015, I really got a first-class education on how to go in and, renovate a park. I mean, I renovated, I think, not personally, but I had crews renovate somewhere in the neighborhood through all the parks, about 140 homes over 2 years.
Wow.
So it was in Albany, Georgia. And at the time, everything was struggling, but that market was struggling. It was just a difficult market. But we exited, we made great money. And then from there, I started to get into mobile home park brokerage. I started thinking, wow, let me go build a team like I've built in the past and focus on the brokerage space and, continuing to work to buy a deal or two a year. And that's what I did. I started a multifamily and mobile home park team, and we did extremely well. We, I bought another deal, and gosh, was it 2016 and the Villages, and there was 127 spaces. And then, and that was on the market for 2 years. I just saw the potential and bought it. And then, bought another park in Ocala, bought another park in Bellevue. And then I ended up partnering on a park in Arcadia with some operators that were really struggling. They were struggling. They wanted to sell it. Performance was really bad. They had issues with the health department. They just had tons of issues. So the probability of it selling was super slim, and they knew that. And they just said, "Hey, would you consider partnering with us?" I'm like, "Yeah, I was waiting for you to ask." So we ended up partnering on that deal a year and a half ago, and we got an offer now. If it closes, that is right over double what we partnered at. So we turned that thing around. We went from about $33,000 in bad debt over 6 months to virtually zero. And
So I'm curious on that. What did you do on that? Because that's pretty impressive, right?
Yeah. So, well, and let me say there's more to the story. So part of it is we just looked at who was late, why, and how that worked. And a lot of them were really getting dinged with high fees month after month. But the goal when we took over was, let's get this stabilized. Let's keep the people that can stay, the people that can stay, we'll get them out. And, ultimately we ended up settling on some of the debt. Some of the debt we got paid in full, but if someone had a $6,000 balance and that balance had been accumulating with late fees for a couple of years, we just went to them and said, "Hey, we have tax season coming up here. We'll settle that debt for $1,500. And, you're current, you've been current, stay current." And it worked out well. I mean, it just, literally we just, the residents, which are the most important piece of any park, they were very thankful. They were like, these guys came in, they partnered, they cleaned up the park, they put up new fencing, they're cleaning the homes, we redid the clubhouse. We negotiated with them, we worked with them, and ultimately, month after month, we probably had on average right at 100 spaces, 0 to maybe 2 that were even delinquent by the 15th. So it worked out well. And then, then we started property managing another park of theirs in the northern United States, same issues. We turned that around, and we were just managing that park. We turned that around and sold it, and we just closed on it for them and absolutely crushed it for them. I mean, turned around the vacancy, turned around the bad debt, fixed the down homes. We just went in there and put our arms around it and took care of it. So it was exciting. But yeah, I mean, so Other Street's my brand. It's my brand of companies. And the way Other Street was formed was I worked on Wall Street out of college, and then I went to work for Main Street, which is more the corporate, larger brokerage firms. And what I realized is I didn't like either of them that much. I feel like I'm not a guy that you can put in a box. I like to think outside the box. And so, Other Streets, the saying is, we're not Main Street, we're not Wall Street, we're the Other Street. So it allows I empower my guys to be entrepreneurial, to do what it takes, to go the extra mile, and not say, you can't do this, you can't do that. It's all about figuring things out and creating a team culture where, everyone really thrives on getting stuff done and learning. So it's been super exciting. So overall, Other Street as a brokerage firm, I've done somewhere in the neighborhood of $2.7 billion. I would say about $1 billion or so is apartments, $1.2 billion, and then the rest has been mobile home park and RV. So one brand of my company is Other Street Advisors, and that's the advisory and the brokerage firm. Currently, we pretty much represent Texas North and then East. We have a guy in Colorado now that covers kind of Colorado down to Texas, so we get more West. And then we have 6 other guys that cover the United States, Texas North and then East on our team. And we've had a phenomenal year. We've had a phenomenal couple years, and we look forward to having more good years. But we'll get into it later. I do see a little bit of a slowdown coming, which we can talk about. And then the other side of my firm is the property management side. We just are vertically integrated with the properties that we own. And from there, we've been asked to third-party manage a bunch of properties, and we've just selectively kind of picked and chosen which ones we wanted to manage because, it takes a lot of bandwidth to manage properties, and, we didn't want to get too far out of our radius. So we also manage our properties and do third-party management. And the third part is more of a venture. It's called Other Street Ventures, and that's our real estate and money raising arms for startups and partnerships. And on the money raising side for companies, we've invested in a company called Tenant Loop, which sold to Buildium. We invested in an RV company called Rover Pass, a company called Air Health, Red Carpet Monday, MedSpeaks, TSO Life, Cold Stone Creamery. So it's our investing arm for businesses, and 6 mobile home parks, and currently working on an RV park and marina in Leesburg, Florida, on Lake Griffin. So as a company, I would just say we're entrepreneurial and a little rebellious, and we like to get out there and make things happen.
That's great, man. That's an interesting story. I appreciate you sharing it.
Yeah.
You mentioned too, I mean, as we're sitting here in mid-November 2022, what's the market looking like? I mean, I'm seeing on my end, obviously like everybody else, interest rates are up. So NOI is not just going up automatically. So if interest rates are up, then debt coverage ratios are constraining the amount of loan to value, which is constraining yield, which is constraining price, or at least price in the mind of the buyer. I'm not seeing a ton of transaction volume right now because sellers are not yet caving on price. So, I mean, we're still seeing regular volume, but it was like, 6 months ago was, okay, this is listed for 2 million. It's going to sell for 2 point something. Now it's like 2 million. I'm at 1.5. What's going on here? And then we can't get it done at 1.8 even. So it feels like there's a lot of, I've been making offers still, and I'm like, I'm not even close on some of these. And it's like this, it's kind of a waste of time. It almost feels like waiting for the market to adjust. Is that what you're seeing? And or what else is going on in the marketplace? You're touching a lot of different markets than I am. I'm seeing some seller finance. I saw yesterday there's got a guy doing a ground lease, and we got guys doing still trying to do wholesales and double close, but I feel like the wholesale's harder. You keep hearing about LPs are going to have to take lower yield. I don't know that they're willing to. I feel like LPs, limited partners, are looking harder at the numbers and questioning the assumptions of the syndicators, because I feel like the syndicators, in order to get to derive the same yield the LPs have become accustomed to, there's this natural temptation to fudge the numbers and overproduce on, or overestimate yield by massive rent increases or not tracking expenses. Or I looked at a deal the other day, and the guy thought we'd have to fill 50 houses in like 2 years in a very rough park. I'm like, that's a lot of houses in a very rough park in a tertiary market. I would say that's more like 5 a year, not 25 a year. And maybe I can get it done 10 a year, but I don't really want to put my money on 25 a year in that particular submarket. What are you seeing, Enon?
Yeah, so let me kind of rehash some of the stuff you talked about, because you made a lot of good points, and I'll start with the last comment that you made. I mean, the reality is we can financially engineer any return we want, right? I mean, we can say cap rates in 5 years are going to be 100 basis points higher or 50 basis points higher, and we can financially engineer returns. And then, we can also say that, we can fill 25 homes a year when the reality is that maybe 15, and our rent increases are going to be 8%. In reality, it could be 5. So financial engineering is something that any of us can do to make the numbers look good. And I think that, you're hitting the nail on the head, making sure that you stay fundamentally sound in how you're looking at things and what you're doing is extremely important, because, we all have a reputation out there of doing things right and doing things well. So we don't want to get into a situation where, we're pushing values or pushing whatever we're pushing with respect to the financial model to make it look like we're going to hit returns we know we're never going to hit because we get an acquisition fee. Totally wrong, totally bad business practice. But a lot of people out there, that's how they make their money. So it is what it is. But I mean, I hear you on that. And with respect to the market, keep making offers. I know that you'll have a lot of guys on the show that are looking to buy or first-time buyers. And listen, that's extremely important from the broker standpoint and just in general, because you want to keep your name out there. You want to keep your hand on the pulse. If you like the product, if you make an offer, it may come back to you. If you don't make an offer, it's not coming back to you. So, and more offers you make, the more engaged you get with, the brokers, the owners, wholesalers, whoever you're working with. So stay engaged. It's a great business. And then one other thing is real estate's a laggard. You know what I mean? Like, we're going to see the real effects of the interest rates rising. We're starting to see it now, but we're really going to start to see it, in my opinion, in March and April as the numbers start to come in, because it's a laggard. It takes time. It takes time for people to adjust. So because real estate's a laggard, we are seeing it a lot. I'm seeing it across the board. I'll give you an example. So out of every, we'll call it mid-size buyers, 1 to 7 properties they own, typically, and I'm making up numbers here, but they'll be close. We have 10 super strong buyers in any market we know we can go to at any time. These are our 10 guys, and there's many more, but I'm just trying to make a point here. And out of the 10 that we knew would be aggressive, that knew they would buy it, the perfect bolt-on, whatever reason it is, out of the 10, I probably see 2 active today. So, I mean, there's been a huge slowdown in buying activity, and even people making offers, as you mentioned, and you're still making them, keep making them. And let's take it one step further. On the larger, more institutional space, private equity space, I would say out of every 10 buyers, we see 4 still writing offers. But we're hearing a lot of people right now say, pencils down. And it's because I just got back from a conference, which you were at, which was NCC. And the one thing I heard from a really good buyer is the problem is our offer today changes tomorrow, right? I mean, it just changes based upon what happens with the 10-year, what happens with debt, or however you want to look at it. So that's the issue is, a lot of these groups have very strong reputations for making an offer, sticking with the offer, not retrading. But the reality is a lot of this is out of their control. So, it's tough out there. And I think my personal opinion on this, Bird, is that we need to see some type of sign from the feds saying that we're going to slow down or pause interest rate increases or hikes, because once we see that, then I think it'll build a little bit more confidence, because we just don't know where it's going and where it continues to grow, because there's a huge spike. I mean, that spike was detrimental to many people. So, I mean, I think that once they say that they've hit the top or somewhere around the top, I think some confidence will come back. But then also, too, I mean, the reality is we're in a recession, if not going to be in a recession at the time. So we think, I'm hearing from other people, we think we're going to see interest rates stabilize, and then we're going to see a pullback. But, you never really know. But that's the sentiment I'm getting out there, is that we're going to head into a recession, and, we're going to see some pullback. And that, in my opinion, that doesn't mean back to 4%, but probably means if we get to 7.5%, that may mean 6, 5.5, maybe that range. So we'll see. But we need the confidence back, and the Fed isn't going to continue to raise interest rates. What I like to do is I pulled this up here. I actually worked on this yesterday, Ferd, and it goes to your point. Can I share my screen here?
Yeah, go ahead.
Okay, thank you. So what I'm getting ready to show you, and let me pull it up here, is I actually put this together yesterday, and it was ironic that we were talking about this, but I was trying to really understand in my mind and being able to have something that I could give to investors and buyers and sellers and so forth. You can see my screen, right?
Yes.
Okay. So this is an actual real deal. I mean, this is a deal that we did, and I took the exact same numbers. So we sold this deal at the beginning of the year at at 4.5 million. At that time, debt was at 4.25. And what we measure to here, just so everyone knows, but this is more of looking at debt tool and how debt affects things. But most banks and lenders are going to write to a 1.25 debt service coverage. It may be a 1.3, but we're using 1.25 in this example, which is very common. So what I did is I showed that if you keep things relative, income, expenses, NOI, and you adjust that interest rate to 6, but you keep the debt service coverage the same, there's a decrease of $9,000 per unit, and it goes from 4.5 to 3.7 million. These are essentially the same values looking at debt service coverage or where we are today. I mean, that's a pretty big change. That's a $1,000 change in value. So then what I did is I said, okay, well, let's keep the debt the same. And again, I'm using 70% 6, which we're at today in that range, is 4.25. But I said, if we keep it all the same, and then let's look out into the future a little bit and go, how much of a rent increase would it take to get to this 4 or 5 number in today's environment? That would be a $60 rent increase on 88 lots. That would be a 16% top line growth in income, and then an 8% growth in expenses. So, my point is there's a lot of heavy lifting here to get to the same value. So, for me to see it visually, it makes a lot more sense than me to hear it. So that's why I was working on this, so I could show my guys.
No, I mean, I get it. It's a great point. That, I mean, that's where I was telling some people at the conference. I met with a couple of other brokers looking at a couple deals, and the price was still, in the 5 caps. And I was like, you want me to pay yesterday's cap rates, but with today's interest rates? I can't do it. I said, the only way that works is if I can convince the bank to lower their rates to yesterday's pricing. I'm not that smooth a talker. I'm not going to convince the bank of that. Or if you guys, as the seller, seller finance it at yesterday's rates, you want to give me a 4% interest rate at 80% LTV, I can pay the same cap rate I used to be able to pay, but I can't pay the same cap rate today, or it wouldn't be responsible, and I can't get the same leverage. So I mean, I'm looking with so of course they don't want to sell or finance. So when I take it to the bank, the real bank, they're like, well, based on the new interest rate, we're going to give you 60% LTV instead of 75 or 80. Well, if I've got 60% LTV, clearly that's going to require more equity. Well, that means my return on equity is going to be diluted because I've got the same old NOI, same old cash flow after debt. There's more cash flow for debt service because debt's less, but generally same old NOI, and equity costs more than debt. I'm going to have a lower yield, which means I need to either take a smaller piece as a GP, or B, push NOI harder than I otherwise would like, which creates risk, because pushing rents too hard, could lead to future vacancy, could lead to turnover, could lead to me getting stabbed, all kinds of problems. Right? So I don't want to change the business plan because I can't get the same type of loan. So I got to change the price. But that means I'm going to have less deal volume.
Yeah, no, listen, I think that you kind of hit on it earlier. We are on the brokerage side. We actually have a few deals that just went under contract where the sellers had no interest in holding paper, and then they agreed to hold paper. And, I think when you lay it out for a seller properly and show them that over a 5 or 7 year period, you can make an additional 800,000, $1 million, to whatever it is. I mean, they don't really know what to do with their money right now. That's the biggest question we get asked. What am I doing with my money? Well, I mean, I think holding paper is a great solution, and we're seeing that happen more often than not.
How do you overcome them? I get holding paper is a good solution. So you can hold paper at say 6% instead of having to trade into something that perhaps 4. Obviously, when you're holding paper, you don't have leverage. Like if you buy into something at 4% cap rate, but you get 75% debt, you can perhaps distort your yield. What about the tax hit? Are they not worried about that? I mean, they have a capital gain tax. Obviously, if you're taking the money over years, you can defer the timing of some of that gain. But is it neutering their ability to do a 1031, or are they still able to do it based on the amounts that are being hit?
Yeah, so that's a good question. So I would say the majority of the time when I see people willing to hold paper, they're usually older. They don't want a 1030. They're not going to 1031 anyway, right? They just want to get it. And a lot of them don't want to pay their taxes. I get it. But if they are going to do something and they are going to pay taxes and they are going to get yesterday's number or close to yesterday's number at an interest rate that was yesterday. I mean, the deals I see happening right now, there's one deal, the seller's holding paper at a 4.5% interest rate, interest only for 5 years.
Wow.
On another deal, it's 5% interest only for 7 years. And I would cautious anyone by doing less than 5 years, make your own decisions, but the shorter time period, the less time you have to react to market conditions and doing what you need to do to get your value up. But it's definitely better than the bank. On one deal that would take bridge debt, we got quoted 9% on that deal, where the owner's going to hold paper at 4.5. I mean, it's a no brainer. I mean, because there's the meat on the bones there. So yeah, I mean, it's the older clientele generally that we see willing to hold paper because they don't want to go operate and own anything else.
Yeah, I think
So-
that's a pretty good option then. If you're not going to 1031, then you can delay some of your gain on the year that the money's received. And if you can get a, quote, guaranteed interest, or, and or your collateral is the property that you used to own that if you got to take it back, you know how to run it. Hopefully they don't run it into the ground in the meantime. But I see more of those deals going. I'm even seeing them on wholesale deals, which is kind of crazy because they don't even, you're seller financing a guy you haven't met yet.
Yeah.
But yeah, I was at dinner at the conference with a group of big operator, and they said they had 4 deals go out that week, 4 offers go out, and all 4 were seller carry. And they said, we're not sure we're gonna get them all accepted, maybe none of them, but that's how they're all going out. I was really surprised to hear that.
Yeah, shots on goal, because the reality is if you're a seller, and again, you're getting offers, let's just make up a number at 3 in today's environment with lending, but then you can get 3.6 because they're going to hold paper. I mean, the 3.6 is a lot more attractive, and they get the bump at the end along with the cash flow. So, it doesn't hurt to ask, especially in today's environment, because though some of them really don't understand the dynamics of debt service coverage and how it affects things, they all understand that money is more expensive and it costs more money today to buy a deal. So therefore you got to pay less. So they can fundamentally wrap their head around that.
Yeah.
So let me show you something else here. I'm gonna share my screen one more time. So this is kind of cool. I'm a data junkie. So, so we track, so this is through, just so you know, the beginning of October. I have this updated on the 20th of every month, typically. So I have this through last month, but here you can see we track we took like the number of properties sold by state and the volume. We track volume by buyer, and I hit these because I hit them on purpose, but we track who's buying. So if I take one of these to show you guys, I mean, this group here, Bovita Group, just for example purposes, I hit it. We're tracking them on 8 deals, and then we follow the brokerage community and how much they sold, and then we also track it by month. So you can see here 61, 34, 50, 62, 62, 62, 39 a drop. That's when things started to get a little wobbly. 43, 29. Now in October, I did look before the call. There were 45 transactions that we tracked in October. The 15 was bought by one group and 4 by another group. So that was 20 by 2 groups, which may be in the other as well. But, you can see that, it is a little bit of a laggard. We do see some pullback from the 60s and 50s. We haven't hit that since July.
Interesting.
Yeah.
So this is not just your brokerage. This is all brokerage, or all deals that you're available to. This public information, basically.
It's not public information. It's what we subscribe to, where we actually are able to pull data from. We have 3 different sources that we use, and on top of our knowledge and what we pull, I mean, we track it as well. Some of them don't track what we track, but this is a mix of 2 of them. And then we put in our database at the end of the year for the final. But we really track this. I mean, this really helps us understand what's going on in the market, but it is a laggard. I mean, I wouldn't be surprised if November is 30 and December's 15. You know what I mean? Like, I think that's the trend we're going to see. Now, next year when people have new powder and a new plan and they're hungry and, we may see it pick back up, but I think all of us are looking for some sort of assurance from the Fed that interest rates aren't going to continue to go through the roof or be hiked. So
Yeah, interesting stuff.
let's talk about one more thing that I think is important. Because I know that you have a lot of guys on here that buy parks and own parks and so forth. And we're in the industry, we're getting a lot of pushback and a lot of negativity towards lot rent increases.
Sure.
And I think that part of it's true. Part of it I think is I don't know the word is too much. And then there are times where too much really isn't too much. So, I'm gonna give you an example. There's a group out there that just gets torn apart at times for their rent increases. But I do know that when they do buy a park, and they buy a lot of value add parks. When they do buy a park, typically they buy a lot of parks from owners that have owned the parks for a long time, and they're just in disrepair. The infrastructure is in disrepair. The water's not good, the sewer's not good, the electric pedestals are bad, the roads are bad, there's no signage, there's no grass. I mean, so when they go and buy these parks and they spend a lot of money on paving and infrastructure and so forth, they do have to do larger rent increases. And I think that's justifiable because they are taking a community that was essentially falling apart, and people live there because they had no place to go. It's not like you want them to go somewhere, but no one else wants to live there because it's so bad. So, it's that, you got to go in there and fix it if that's what you choose to do. And that's where a lot of these big rent increases come into play. Now, with that being said, I wanted to touch on expenses, with inflation and all the things going on in the world today, as buyers are out there, owners are out there. I think right now is a very important time to really understand the numbers. So, in Florida, for example, I'm pretty positive taxes are going up 10% to 13% every year because they can increase it by 10. And then you have the school board, which goes from market value instead of assessed. That's where the other three comes in. But my point is taxes are going up. This is how municipalities fund their budgets. So they're going up. So you got to underwrite tax increases on a sale. These are all important. Insurance is going up. If you have park-owned homes, your liability insurance for the park-owned homes, it's going up dramatically because of fires and because of slip and falls. So just be cognizant of those increases. Water and sewer going up, not 3%, 6, 7%. Electric, labor. So, the old fundamentals of top line will increase by X, expenses will increase by 3% across the board. Be careful, don't get caught, because expenses are increasing more than 3%. So my point is just, make sure you dig in, you understand numbers, understand where they're going as you're pro forming this stuff out, because, expenses are also leading to larger rent increases. Because if, electric's up $4, water and sewer is up $4, and making this up, taxes up $10, and insurance up $2, that's $20. So your increases on your expenses before you make $1, $20. So you increase by 20, your NOI could go down, if not stay even. Have to increase more than that. So larger rent increases may be coming and still coming because of all the inflation or the expenses increasing so dramatically. So pay attention to that. It's important.
No, I think you're right. I think I'm seeing more and more large increases. I think it's a slippery slope as far as worried, you don't want to get rent control. You don't want to hurt the ability to infill lots and sell homes because new home prices are way up too. So it's like, it's harder. I mean, I had the manufacturers, I had 2 of them call me last week and say, hey, you need any more homes? And because sometimes they call me when they're like, hey, we got to run a 10 and we only had 9 filled. I got a 3-month backlog, but I can get you 1. I'm like, sure, I'll take the 1. But it's been 3, it's been 6, it's been 12-month backlog. 1 year, they wouldn't even give me any homes, even though I'm like, I bought 40 homes from you last year. They're like,
I know.
We have guys that buy 100 at a time. And I was like, oh, okay, yeah, I'm not that big a deal. So they blew me off. Well, the same guy calls me last week and says, you need homes. And I said, well, do you have like 1 extra run? He goes, no, we just we're running out of orders. So we're
Yeah.
making calls, and I'm like, wow. They're worried about having a downshift. And it's like, okay, that's because, and I bought like 12 of them from them like 60 days ago, but I'm still setting those and installing those and so on. Like, I don't need any more right now. I was like, and they're harder to sell because the price is so much higher. So it's like, if you're gonna put higher lot rent and higher home costs, you're pushing the rents. And part of the value proposition for our customers is for the same square footage and the same quality, we're much cheaper than apartments. So why would you go to apartment? But the more that the home prices go up and the more the lot rent goes up, the harder that gap is going to be to fill, because it's going to be, a tougher value proposition.
Yeah, no, I agree. I mean, I got the same call 2 weeks ago from a group that we bought, I think 59 homes from over a 2-year period. And they literally said no more orders to any other than our dealerships. And I found out that wasn't true. They were backing some larger owners. It is what it is. But, they are kind of calling now, begging to give orders. And, I'm like, well, you forgot about me before, but the market changes. Look, I'm not going to hold anyone hostage over that. But, I just said, I want you to remember next time I need something. And, I'm a small guy, I'm a small player, but I'm consistent. I'm consistently small. So, be there for me. So, yeah. And I have seen for a little bit of pricing coming down on the homes, actually. I've seen a little bit of pullback on the home pricing, which is great. But, here's where I think, and I'll touch on this, here's where I think the distress is coming, is that a year ago, you couldn't get homes for 9 months. I mean, and then throughout the majority of this year, you couldn't get homes for 9 months. Well, I think the guys that went out there and bought parts over the past 2 to 3 years and didn't execute on their game plan, didn't get homes in time, were on a 3-year short-term loan, bridge loan. I think those are the guys that we're going to see that ultimately are going to be in the hurt bag, or they got to sell, because they're not going to be able to refi where they thought they were going to refi, because they didn't meet their hurdles on getting homes in. They didn't meet their CapEx improvements. And banks now are being much more critical, and money's much more expensive. So, we're going to see a lot of those groups that didn't execute. I think that's where we see the distress coming from. I don't know if it's necessarily distress or they just aren't going to make a lot of money, but it could be either one.
No, I agree. I mean, I've seen it happen where, the business plan required, I'm going to fill 25 homes a year for 3 years. And then the first year they got zero. Wasn't their fault even, but they got zero. Like, you can't make that up very easily. And then you've got to make it up, and then you got to pay 20% more.
Yeah.
It's going to be hard to make that up the next year. So, I mean, I've seen some, a lot of times with my clients, they say, just do the paperwork. Sometimes they just do the syndication. Sometimes they say, just do the zoning. Sometimes they say, look at our business plan and give me your opinion. So then I will. But sometimes I'll look at the business plan, and I remember one time I did give them my opinion. They didn't want it. I said, I'm 15 years older than you. I got more experience than you. I got more money than you. I'm smarter than you, and I can't get that loan. So how are you going to get that 80% cash out refi 120 days in based on your immediate sub-meter and your $50 increase? And you're going to take all the cash out, pay your investors off. And they was just like, look, guys, I'm just trying to be honest that this is a failing business plan, and you can't, which bank? If you find them, let me know, because I'm switching all my business to this bank until they go out of, at least until they go out of business, making loans like this, right? So anyway, I see those pro formas all the time. And, we jokingly around here all the time that I was telling my analyst the other day, I said, in the history of Microsoft Excel, no business plan ended in bankruptcy, but in real life, businesses end in bankruptcy on a regular basis. I said, think about the restaurant business. I said, how many restaurants fail in the first year? Like 50%. And how many fail in the first 3 years? Like 80%. And I think those 80% are the guys that had the courage, the idea, took a shot, put their blood, sweat, and tears in it, and also convinced investors to trust them, convinced the landlord to take a risk on them. Maybe some of those landlords put in tenant improvements, convinced the bank to make them a loan. And most of them were still wrong and in bankruptcy. But I can assure you, their pro forma model shows them making so much money. It was the best decision of their
Sure.
life. And then
Sure.
I'm not trying to be rude to those guys, but the reality is rosy assumptions are not your friend.
Yeah.
Questioning assumptions, questioning numbers. That's what I was telling analysts. I said, as an analyst, I used to be a financial analyst. Your job is to question numbers and not to be nice to people and not to make new friends, but to question numbers and be critical and be analytical. And I feel like that hasn't happened in a lot of respects. And then in COVID was and to some degree still is a wild card that nobody was ready for. Overall, our industry fared better than most. I'm glad I was in this business, not the restaurant business, because
Sure.
there are good restaurateurs that got hit in the shorts, even though they didn't do anything wrong. But yeah, I think that's where you're right, that the stress is coming when perfect storm of aggressive underwriting, inexperience, crazy macroeconomic factors from a supply chain, crazy macroeconomic factors from an interest rate and cap rate standpoint, with a short-term loan with an aggressive fee structure of a syndicator. And it's all the timing may not be long enough to get them out of hock.
Yeah, I totally agree. It's, when it's, I've met with a lot of them over the past, a bunch of owners over the past month and a half. And, it's, I can feel some of them worried, but, look, I want the best for them. I want them to prosper and do well. And I want that for everyone. But, some of this stuff you couldn't even predict. I mean, who would have predicted, it's,
Right.
I mean, literally when they turned off that valve saying 9 months to get a mobile home, I mean, that valve turned off in like a month and a half with all of them. I mean, it wasn't like any of us saw it coming because I was still placing orders. I needed 18 more homes. I remember at the time, and I had my COO call and say, let's order 10 more homes. And she goes, they're not taking any more orders. I'm like, what? Like, what do you mean? So I'm like, well, call the other company. She's like, they're 9 months out. I'm like, no, call the other company. So
Right.
I'm like, what? Call the other company. And then I'm like,
I
oh
know.
my God. So then I start asking and everyone's like, yeah, this is coming at us. And I'm like, oh my gosh. So they didn't expect that, you know what I mean? And now interest rates, I mean, I don't think any of us would have thought I mean, look, I think we all knew interest rates were going to increase, but I think, and I won't get into my thoughts on that, but I think for several reasons, interest rates increased as fast as they did just because they meant to do it before and they just didn't do it. So, and then when they all got back into session, we all got the brunt of it very fast. So, yeah.
It's been a wild,
Interesting
wild
times.
couple of years, right?
Yeah.
Couple of years.
Yeah.
All right, man. Well, this is good stuff. Any other tips or tricks or ideas you want to share before we jump?
No, man, I would just say, look, it's a great business. It's always going to be a great business. Take care of your people, run your properties the best that you can. If you're thinking about selling anytime soon, get prepared with your books. I mean, there's certain things you need to be doing with your records and your books. I can't tell you how many times we get on the brokerage side, we get bad data, or they're renting, they have a park owned home and their lot rent and their park owned home rents combined. And, you really want to there's certain things you want to separate it. There's certain things that you want to do in order to get prepared to sell or even to run it. I mean, listen, I'm of the opinion, if you have park owned home, you need another entity, get them out of your main entity. You don't want the liability. So there's certain things out there that, you need to do and need to be aware of. And listen, I'm here as a resource and my team's here as a resource, and anyone can contact me anytime, and I'll do my best I can to help you. That makes me happy. So, yeah.
Great stuff, man. Appreciate it, Enon.
Yeah. Thank you. Thank you for having me on, and everyone have a great year and good luck. And Ferd, I'll see you soon.
All right. Sounds good.
All right, man. Have a good day.
Too.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.